Well, hello everyone. This is Carlos, your market and tech trainer for KW Advantage and Experience. And again, with another KW sessions. With me co-hosting is Mr. Tom Mitchell. Hi, Tom. How are you doing?
Hey, Carlos. Thank you. How are you?
I am living my dream, sir. Um,
Good.
Thank you for having and joining us today. Would you care to introduce our special guest for today?
Yeah, it's a great pleasure. Rob, we've known probably 15, 18 years. Rob's handled all our business tax affairs. He's our go-to consultant to discuss different business opportunities that we're looking to endeavor in. He has a broad accounting practice that handles commercial, personal, um, the whole gamut. And he's our resource guy that we use on a regular basis for Diane and I, not only for our personal stuff, for business, and we trust him, and we can't talk highly enough about him. So you're in good hands today, folks. So listen to what he's got to say.
All right. Thank you for that
Thanks, Tom.
introduction. Let me read through here. But Rob graduated from with distinction from the University of Toronto, Bachelor of Commerce program specializing in accounting and economics. Following his university studies, Rob began his career in public accounting. And in addition to his CA designation, Rob is also a certified financial planner. Family man, again, one of Tom and Diane and the office's most trusted people. Without further ado, Rob Chaggares.
Thanks, Carlos and Tom, and there's a few other names I recognize on here too, so it's nice to be with you today. I've been asked to put together a little presentation on wealth building, and just to give you a little bit of background. Yeah, I started out, my KW introduction was really through Tom and Diane when Diane got involved with it first and worked closely with her and Tom during those beginning years, and have continued to kind of grow my practice and my business as KW has grown in this area, and we've kind of grown together. So I deal with quite a number of the Keller Williams brokerages in Southern Ontario, and a lot of the agents and larger teams we're connected with. We've done presentations over and over again over the years on tax planning and wealth building. Anyways, thanks, Martin. I appreciate the opportunity to talk to you. So one thing I think that would be great, I've got a little presentation that I'm going to put up to share the screen and just kind of talk our way through this. We'll talk about some high level planning ideas for realtors. We're a year and a month into the world of personal real estate corporations. And so probably most of you are at least vaguely familiar. If you don't have it yourself, you're at least vaguely familiar of the concept and how it might be useful. So we'll talk about that. We'll talk about some planning you can put in place once you have a PREC, the idea of tax deferral and minimization. And we won't get too much into the investments. Martin here is an expert in that. And one of the things that he deals with a lot of real estate agents is using insurance as an investment. I've got an investment business as well that kind of partners with my accounting practice that we talk to our clients about. So there's lots of things that we can get into, but what will make this especially useful is if we can make it a little bit interactive. So we've got a chat function here, a couple of comments in there already. Feel free to throw comments or questions into that chat anytime, and also if you feel more comfortable, you can just unmute yourself and we can have a back and forth on any questions you have. Because my experience with presentations is if one person has the question and you've got a group like we do here of now 44 people online, if one person has the question, probably it applies to a few others. So don't hold back, please. So I'm going to share my screen, and we are going to go through.
No pressure, Rob. We had 44 and going up.
And going. That's good. It's good. We'll use our time as effectively as we can here. So what we'll do is just kind of go through a little bit of an agenda here, which is going to talk about the idea of incorporation, the use of corporation for tax purposes, planning opportunities that come about because of corporations. And we'll go through a little bit of the basics for tax. So here we are, November 24th. We're just a few months away from tax time. So it's right around the corner for us in a public accounting firm. We are planning already for the upcoming tax season. So you guys probably should be as well. All right, so basically we've got a few structures. There's sole proprietors, partners. Most of you, if you're not incorporated, are probably one of these two. Then you've got corporations. There's still some sub brokers that are out there. A few years before personal real estate corporations became a thing and were allowed, we started to use things called sub-broker corporations in order to allow people to get some of the benefits of the tax savings and deferrals that come from the use of corporations. And a sub-broker corp is while they're around, they're not being set up now. So the ones that are still in existence are in existence just because they were set up before precs were allowed, and it's probably more hassle to unset them up than it is to do anything else. So you'll know that there are some sub brokers out there. It's like a broker working under a broker. You have to do, the reason why we don't set them up now is because to get the benefit of incorporation, and if you do a sub broker, you have to deal with all the stuff with TREB and RICO that a regular full-size brokerage has to deal with. So the deals have to flow through the sub-broker. The trust account has to be present. You're subject to trust account audits and all of the things that a broker is. So you have to have a broker of record. So precs are really the way to go. And precs are, again, like I said, they were allowed effective October 1st, 2020, so a year ago. And we set up, I don't know how many, maybe 75 or so precs last fall. And they've been, I think a lot of the real estate agents are using them now. So liability from a sole proprietor or partnership situation, you are the business. And that's the thing. And from a tax standpoint, it's the same. So a sole proprietor, literally every bit of income that the business makes shows up on your personal tax return. And the same thing for a partnership. A partnership most commonly in real estate is a brother and a brother, or a husband and a wife, sister and sister, brother and sister, something like that. Some kind of family connection where they're a team, and the income is earned directly into the team and then split 50-50 or whatever the split is. And whatever the net income is, regardless of how much cash you've taken out of the business, you're taxed on the income. And so from a liability standpoint and from a tax standpoint, you are the business. Therefore, everything the business makes, you're taxed on. If there's any liability for the business, you're also subject to that liability. Corporations are different. So corporations are a separate legal entity, and the separate legal entity is separate from you. And so if the corporation gets sued, it doesn't necessarily mean that you get sued. Now, precs are different though. And so a personal real estate corporation is not allowed to sign off on a deal. I'm not sure if any of you are brokers or if you're the broker for either Experience or Advantage, but you would know if you were that the actual agent has to sign off on each deal, not the prec. The prec simply is a recipient of the commission. So the way that the legislation was written up in Bill 38, which was the Fairness for Realtors Act, the way that it was written up is a prec simply receives the commission, and the agent is able to direct their commission to the prec. So it's a really nice situation from a tax standpoint, but from a liability standpoint, it does nothing because you're the agent that's still signing the deal, which means that if something goes wrong, if you were negligent or if there was an issue and there's any kind of lawsuit, you're going to get sued personally on that, not the prec. Well, actually, the way it'll work is both of you will get sued, the prec and you. But the liability, it's really no different from being a sole proprietor. So the tax differences are the big ones. We talked about the tax filing differences. If you're a sole proprietor or partnership, it's just a personal income tax return. It's an additional schedule on your personal tax return, but that's really the main thing. For a corporation, it's a full separate corporation. Here's where we start to get into the interesting part is personally, I'm going to flip actually to a schedule at the end. This is the personal tax rates in Ontario right now. So take a look at this. I'm not sure if I can, maybe it's easier if I do this. Is that better? if I scroll, can you see it more clearly if I do it in presentation mode?
Yeah, you're not in presentation mode right now.
Okay, let me see if I can do this. Is that a little more clear?
100%.
Better.
Better. Okay, good. All right, so these are the tax rates for Ontario right now, 2021 and 2022. So this is current. This is over the next 2 years. You can see in 2021 that at $220,000 of taxable income, you get taxed at 53.53%. 216, 51.97, 151,000, it's 48.29. So you're basically 50% on everything over $150,000 in Ontario, and that adds up. So if you're a realtor that has, GCI of $450,000 or $350,000, and you've got $100,000 in expenses, you are going to end up paying a lot of high rate tax, a lot of tax at 50% or higher. And so the use of a corporation is really to allow people to pay tax at one of these two rates. So we just looked at the personal tax rates. The corporate tax rates, the first $500,000 that a corporation earns net after expenses, is taxed at 12.2%. And then anything over 500,000 is taxed at 26.5. We don't really deal with that too much. There's a handful of agent teams out there that might have net taxable income after expenses and salaries of over 500,000. But most, if you're an individual agent or a family team, you're going to be dealing with, $500,000 of income or less. And the beauty of this is, you got a 41.3% net deferral by leaving money in a corporation as opposed to having it earned personally. And so the real benefit here comes from right here. Once the business is profitable and you're making more than you need to live on, a corporation can save you substantial dollars. So that's exactly what I'm talking about. If you've got a tax rate that would otherwise be 53% or 50%, and you can leave it in a corporation, have it taxed at 12%, then you've got a substantial savings. So I'll give you an example of a scenario of somebody that has $250,000 of net taxable income on their personal tax return. That's going to result in $30,000 taxed at the highest possible rate and about $70,000 taxed at 50%-ish in that ballpark. So it's a lot of income tax on that top $100,000 from $150 to $250, about $50,000 of tax owing. If that person finds that after they've paid their income taxes, after they've done everything, that they are saving $50,000, it means that they didn't need the top $100,000 because they saved everything that they didn't pay to the government in taxes, $50,000. In that scenario, had they incorporated, taken a salary of $150,000 out of the corporation and left 100 in the corporation, instead of 50,000 in tax, they would have paid 12,000 in tax. And that's the benefit. So here's the easy kind of cheat code to determine whether or not you think you should incorporate. The answer is, if you are saving a significant amount of money each year, like $20,000 or more, then you're probably a candidate to incorporate and to use a PREC. And so the idea is, if you're investing in real estate, if you're investing in other things like stock portfolios, private companies, whatever the investment that you're working on is, if you find that you're able to make that investment out of excess cash flow, then you should probably be incorporated. So with that, the PREC is a pretty easy setup. And so I've got a little kind of setup down here that talks about what the cost is. When they first came out, you guys have heard that there's some inflation going on in the economy right now, right? So inflation has hit corporations and lawyers, and it's not actually the lawyer's fault for it. It's OnCorp, which is the standardized online program that's used by all the law firms in Ontario to set corporations up, to register business names, to do all that kind of stuff. And they just increased their cost by $500. So $250 actually is a government increase in the cost of setting up a corporation. And the cost to buy the minute book and to set up the minute book OnCorp increased that price by $250. So between the government increase in costs and the OnCorp increase in cost, the cost of setting up a corporation has actually gone up by $500 in the last month. That came out, there's a Globe and Mail article a month ago that announced that increased. So unfortunately, the cost of setting a PREC up is more now than it was a month ago or a year ago, but it's still relatively inexpensive. If we're looking at a scenario where you could save, like I just said, if it's 50 versus 12, you've got $38,000 less tax payable. $1,900 as a one-time investment to get set up is really not that bad of an investment. So the cost, there's an additional cost that you should know about, and it's not required, but it is recommended. And when you have a business, I think most realtors would recognize that their real estate business is probably not too saleable, right? Like if you think about your practice, could you take your business, put it for sale, and have another realtor buy your business? That generally doesn't happen. There may be databases that you have that are of value that could be sold, something like that. But generally speaking, a real estate practice is not worth a whole lot in a third-party sale scenario. But there's a section of the Tax Act that deals with transfers of property from personal ownership to a corporation or from a corporation to personal. And so if you have a sole proprietorship that has generally made significant income over a period of time, and you're going to transfer it into a corporation, there's a risk that the CRA could say, hey, any business that makes $250,000 a year for 5 years in a row is worth something. And so if you transfer it into the corporation, they could deem a capital gain to take place on the transfer of that business. So there's a simple filing that we do, which is an election under Section 85 of the Income Tax Act. And essentially you can elect, instead of having the transfer happen at fair market value, which the income tax requires unless you elect out of it, you transfer your sole proprietorship or partnership into a PREC at its tax cost, which is nothing, right? You didn't pay anything for the development of your real estate practice. So we elected at $1, and what it does, it's about $750 worth of accounting time and filings with the Canada Revenue Agency. A little bit included in that is legal costs as well, because there's some agreements that have to be done up. But what that does, it guarantees you that at some later date, the CRA won't come back and assess a capital gain or some kind of income inclusion due to the fact that you transferred your business in. So with that, I've given a lot of information here. I do see that there's some questions in the chat, and so I want to talk about that. That part that I just covered is fairly complicated, but it's one of those legal issues and tax issues that's fairly high level. And generally speaking, our position is we encourage our clients to fill out that election to transfer at tax cost. So you can kind of ballpark the cost of incorporating now and creating a PREC in the ballpark of $2,500, $2,600, whereas it used to be maybe more like $2,000 or $21. Okay, so a couple of questions. Laura, hi Laura, how are you? We've got, does the PREC protect you from liability? If it's a lawsuit not related to real estate transaction, does the PREC provide you any protection? The answer, 100% yes. So the only way that you could be sued in the PREC would be directly related to income earned as a result of a transaction entered into as a real estate agent where you directed your commission into the PREC. So I hope that makes sense. So if you enter into a transaction, you make money off of that transaction, you were negligent in that transaction, but the fees for the transaction went into the PREC, then the courts would hold that the PREC assets as it relates to that transaction would be available for that lawsuit. If it's something completely different, a car accident, then that corporation is completely separate and apart from you. And the assets that you build up inside of the PREC would not be subject to any kind of liability from non-real estate dealings. Can you put property under a PREC? The answer is yes, but you don't really want to. It depends on what type of property. So Ed, normally property I would think of in terms of real estate. Is that what your question is related to, Ed?
Yes, investment property.
Yeah, so there's a reason why you wouldn't want to. You may actually want to put a commercial property in a PREC, but again, that I would even suggest you wouldn't. Residential real estate, like rentals, residential rentals, you wouldn't want to put in a PREC because a PREC is a commercial activity. And if you have a commercial activity, the banks will not lend to a commercial entity at residential mortgage rates. That's the big thing. I actually have a slide that I'll share with you that is right here. And what this is it's different options. Once you have a PREC, so that PREC is a commercial activity. It's a commercial business. The only type of loan a bank's going to give you is a commercial loan. Interest rates, of course, on commercial loans are higher than they are on residential loans. So in order to save yourself money, you can set up something called a single purpose real estate investment corporation, which is just a normal corporation, but all it does is own and operate residential rental properties. If you do that, the banks will give you residential lending rates, maybe plus a small premium, plus 0.1, something like that %. And they'll do it for up to 5 properties. And if you do that, then you get the benefit of both worlds, using after-tax corporate money, but you're doing it at residential lending rates. And the key to it is that you can lend money from a PREC to any other corporation that you own without any tax implications and without interest. So you can take your savings, your retained earnings, the money that you save up in the PREC that you do not take out, and you can lend it tax-free and interest-free over to another corporation that you own and control. And then you use that money as your down payment, and you can buy properties. You can use it for anything really, but in the terms of this type of purchasing of residential real estate or any kind of real estate. Commercial too. The reason why I wouldn't suggest you put a commercial building in there is because commercial buildings generally come with more risk. Right, so a commercial building, take the Advantage office down on Queen Street as an example. So you've got people walking in and out of that building all day long, every day of the year. And so the more people that walk through that threshold, the more risk of a slip and fall lawsuit, the more risk of any kind of lawsuit. And so if I've got a PREC that I'm building up every year, $100,000 of additional retained earnings, within 10 years, I got $1 million of my hard-earned money saved up inside of my PREC. And if I put a commercial building in there and somebody has some kind of slip and fall lawsuit, all of the money that I've worked hard to build up is now exposed to the lawsuit. And so for the simple, protection of incorporating another company off to the side, like that picture I just showed you, where you've got a second corporation set up, you can lend your money into the second corporation from your PREC. And if there's ever any kind of liability or issue associated with the property that you own, it can't touch the PREC. So that would be my answer. Ed, does that answer your question? Any additional follow-up questions on that?
Yeah, for sure.
Okay. Tanya, you've got, what's the benefit of incorporating versus personal if you are using most excess savings to invest in real estate and stocks? So that is right exactly a nice summary of what we've just been talking about. So if you're investing any kind of significant money, I'm not talking $5 grand a year, I'm talking $25,000, $50,000 a year. If you're investing, you're buying one property every 2 years, something like that, that means you're coming up with 100 grand to 150 grand for a down payment every 2 years. And the benefit is that you can save so much faster inside of a corporation. So if I'm paying 12% tax in the corporation, I can save a lot faster with that tax rate than I can if I'm paying 50% tax in my personal taxes, right? And so the benefit is on the personal side, if you're not incorporated, every dollar that you earn gets taxed in your personal hands at your personal marginal tax rate, which goes up to as high as 53.5%. If you are incorporated, you only get taxed on what you draw out of your corporation. So we can either take it out in the form of a dividend or a salary. And so if I only need $120,000, 10 grand a month gross to live on, then that's what I take out. If I need 20,000 a month gross to live on, I take that out. A lot of people that are living on $20,000, $25,000 a month, consuming. When I say living on, I mean consuming, right? Like it's going into your shelter, your food, your entertainment, your lifestyle. If that's the case, a lot of people that are making that are actually making more than that. And so if we're in a corporation type of setup, then we're able to leave the money in the PREC that we don't need to live on, save it, only pay 12% tax on it, and then invest what's left over. So our investing happens more efficiently. Tanya, does that help answer your question?
Yeah, that's great. Thanks.
Okay. Casey, what rate are you taxed at when you dissolve your PREC? Good question. Say when you reach retirement as part of your estate after passing. So great, really good question. This is where Martin actually comes into play. I don't know how many of you know Martin Hutnick, but Martin works for 33.7. He's an insurance broker and an agent and kind of an expert in using whole life insurance policies to help people plan for retirement and estate planning. It can be used for other things too, but I'm going to focus on that, Martin, if that's all right, just that aspect of it. The idea is, let's say we get a PREC that you build up $2.5 million in. You've got retained earnings in your corporation of $2.5 million. You had it for 20 years. You've saved $75,000 a year over those 20 years, plus you've had some investment growth. Okay, nice little scenario. When you retire, that PREC is very much like an RRSP. So when you retire and you've got RRSPs, you now change from being a contributor to a savings plan to an annuitant of an income fund. It changes from an RRSP to a RIF. Maybe some of you are familiar with that. So on the December 31st of the year that you turn 71, you have to convert an RRSP into a RIF. And the mindset changes. I'm now not contributing, I'm withdrawing because I'm in retirement years and I'm taking money out. A PREC is pretty much exactly the same thing, except there's no requirement to take it out. But what happens is I built up $2.5 million in my PREC, and I now change from saving money in the PREC to taking money out. And I can take it out in the form of a dividend. One thing that's nice, in 2018, there were a whole bunch of tax changes that happened in Canada that were negative for small business owners. But one of the positive things that came out of it is they allowed for full-on income splitting of dividends with spouses once you're over the age of 55 years old and retired. So if you're retired, you can then start to pull dividends out in the hands of both the husband and the wife, or whatever the family situation is. And it comes out fairly tax efficiently. So that 2.5 million, you start to draw it out. Here's where the insurance comes in. And the second part of your question, Casey, which is, if you passed away and you held shares of a corporation that had $2.5 million in it, and you didn't have a spouse, okay, so there's a few ifs that have to be there, because when one spouse passes away, predeceases another one, the remaining widow or widower has all of the assets transferred tax-free to them. Okay, so everything rolls over to the spouse, but the last to die spouse, or in the case of a single person, when you pass away, everything you own is deemed to be disposed of at fair market value immediately before death. And so if you own shares of a private corporation, your PREC, that are worth $2.5 million, then immediately before you die, you're deemed to sell it at exactly its fair market value, 2.5 million, which results on your terminal tax return, your final tax return, in a capital gain equal to $2.5 million less the costs that you paid for it, which is nothing. You incorporated, you paid the lawyer $1,900. That's not what you paid for the shares. Generally speaking, we just pay $1 for the shares, or $100 or something like that. And so the capital gain is $2.5 million. I'm going to take you back real quick to the tax rates, because there's an important tax rate there, which is capital gains. So you can see other income is the main one that we focus on, because the other income column is the tax rate that applies to salary, business income, self-employment income, rental income, interest income. But then you've got capital gains, which is in this next column over. You can see that capital gain is exactly half of each of the other income brackets. And it's because half of a capital gain is non-taxable. So if I died, let's use easier math instead of 2.5. Let's say that we died with a company that had $1 million in it, just to use easy math. And we were at the top marginal bracket. The capital gains tax rate at the top bracket is half of 53, 26. So we'd have $260,000 of income tax payable by the estate on the shares of that private corporation. The corporation still has the $1 million left in it. And now that the beneficiaries, your kids or your family that you've willed the company to, are left owning shares of a company that has had $260,000 of tax paid on it, but still has $1 million locked inside of the company. They have to pull a dividend out, which could pay tax. We'll share again, just real quick. Dividend taxes on small business, non-eligible dividends, go down to the bottom, could be taxed as high as 47%. And so if you have a scenario with $1 million in a corporation, on the death, the estate has to pay $260,000 of tax, then the beneficiaries may have to pay as much as 47%. You could end up paying well over 60% tax, right? 47 plus 26. You're looking at
Rob,
tax. Yeah.
do you mind going back to presentation view?
Oh, sorry, I thought I was. My bad. Is that better? Is that presentation?
Perfect.
I've got,
Thank you.
okay. Okay, so you can see that the tax rate on dividends, non-eligible Canadian dividends, is this column where my mouse, I think you can see my mouse, is the very bottom one, 47.74. Capital gains, the highest rate is 26.76. And so all of a sudden, if you work it wrong, if you don't do any planning at all, you could end up paying 73% tax on the $1 million. And so instead of inheriting $1 million, your kids actually only inherit $270,000 out of the $1 million. Worst case scenario. So what we end up doing is usually recommending that our aging corporate clients and even middle-aged corporate clients look at insurance policies. There's a type of policy called a whole life insurance policy, which is like an investment. And you can start to move that $1 million over a period of time from one type of investment into another type of investment. That type of investment is actually an insurance policy, a whole life insurance policy. And there's magic in that strategy. So if you don't need the money that's in that PREC, or you don't need the money that you're going to allocate to the insurance policy, what will happen is when you die, the death benefit will pay out in the insurance policy. And let's say you buy a policy that has $1 million death benefit in it. That $1 million is received by the corporation 100% tax-free. Insurance proceeds are not taxed. Life insurance proceeds are not taxed in corporations. On top of that, the corporation receives the insurance proceeds into an account called a death benefit, or a capital dividend account. The capital dividend account is then able to be paid out tax-free to the shareholder, which is your beneficiaries of the estate. And so the $1 million, instead of being dwindled down to a rate of $270,000, the beneficiaries now get tax-free $1 million into their hands. They still have to pay the capital gain of $260,000, but they end up with 74% of the money in their hands personally, instead of maybe only 27% or 23%. So there's a strategy with the use of insurance that can make the transition of a corporation from one generation to the next much more tax efficient. There's also something else called a pipeline transaction that I don't want to get into too much. It's a very complicated tax and legal structure that converts that 47% dividend into a 26% capital gain for the beneficiaries. It's an expensive, costly thing, but if it means saving, a couple $100,000 in tax to spend 50 grand in legal fees, that's worth it. And so that can be done as well. So you can actually bring your effective rate of tax on the transfer of assets from a corporation, small business corporation, to the next generation to about 55%, best case scenario. But if you use life insurance, you can get it far below that. So I hope that helps a little bit with Casey's question. Casey, any follow-ups on that for me? Maybe we lost Casey in the middle of that. Adam, I have a PREC. I was thinking about opening a trading account under the PREC. Would you recommend this? Yeah, I would. Yeah, I would not set up a second corporation just to do a stock capital markets type investment portfolio. I would do that inside of your PREC. There's no liability associated with investing in stocks. So unlike real estate, right? Commercial especially, but residential real estate as well, that deserves a separate corporation. A stock portfolio can totally be done inside of your PREC. No worries. Next one, Dan, can pensions be directed straight into a PREC? The answer is no, unfortunately. So what happens if you have a pension somewhere, you're going to get an opportunity if you want to move that pension into a self-directed account called a LIF or a LIRA. During your contributing years before the age of 65, it's called a LIRA, a locked-in retirement account. A LIF is actually LIIF, and it's a locked-in income fund. And it's a self-directed pension, essentially. So if you're, if you worked for some company, public body, some government agency that you contributed into a pension, you have contributions, you leave that, now you're doing real estate as your primary activity. You still have this pension amount there. You can go to your pension company and ask them to get you the paperwork together to determine how much money you actually have in there and what the lump sum transfer would be if you were to take control of it yourself. You can leave it with the pension sometimes. It depends on the pension fund. Sometimes they'll allow you to keep it with them and just have them manage your money. Oftentimes I recommend though that people take control of it themselves because it's all a gamble when you're dealing with any kind of retirement scenario, a pension especially. If you pass away at 2 years after you retire, guess what happens to your pension? Gone. Unless you have a spouse, in which case they're going to get whatever percentage the pension fund allocates to a survivor spouse, which often is best case 60%. Usually 50%, something like that. And so, it's a bit of a gamble. If you've contributed your whole life to a pension fund and you built up a large amount, if you transfer it into a LIF instead of allowing the pension to pay you out, yeah, you run the risk of maybe not doing as well with your investments. But if you die before you've taken all of it out, then you're able to transfer that asset onto your posterity, onto your beneficiaries. The other risk though is that you could live to 125 years old, and if it's under your own control, you got to make it last. If you're a pensioner, the pension has to pay you to the day you die. And so, we're always gambling when we're talking about, what we're going to do. And usually we're just using kind of that actuarial information, the average age, expected age of a man or a woman, and, taking into account your own particular family history, that kind of thing. All right, Susan, you've got a question. Is it best to be paid salary with deductions and taxes or dividends? This is a bit of a question that's particular to you. Best probably tackled one-on-one with your tax advisor. I'll give you some general ideas to kind of make the decision. So dividends are super simple and do not have taxes withheld. You report them once at the end of the year. That's it. You file a T5, and then you're responsible to pay income taxes based on the income that you've taken out. The downside to dividends is, number one, banks don't like them. And so if you're trying to get qualified for a mortgage on an investment property or something like that, and if you have a banker that doesn't get it, that isn't that, experienced in dealing with self-employed people, they may not understand that a dividend is completely up to your discretion, and it's exactly the same as a salary as far as income is concerned. A lot of bankers don't get that. And so I've had clients struggle getting financing being on dividends. So another consideration is, we just went through, I guess we're not through it yet. That's why we're doing this virtually, but we're in the middle of a world pandemic, right? And so we've seen that the government prefers salaries, straight up. They have programs that incentivize self-employed people to take salaries. Things like the wage subsidy, things like CERS when it first, or CEWS when it first came out, CERB when it first came out, which was the Canada Employment Benefit. Those things didn't qualify for dividends. They actually ended up adjusting one of them to qualify for dividends, but not the CEWS, which was the wage subsidy. So the government wants you to take a salary. They prefer that. They want to get their money up front. They want you to be paying in a CPP. So I'm actually starting in my practice to say to people, listen, you may just be better off taking a salary than a dividend. Prior to that, I was always a big fan of dividends. The last 15 years, I've been encouraging people to take dividends, and I've taken a dividend personally up until last year. Last year was the first year I took a salary out of my corporation. And the reason is because of all these subsidies that the government's giving out. And, essentially there's programs that incentivize us to take salaries now. The downside of a salary is CPP. you guys all pay it, whether you take a salary in some fashion or you're self-employed. When we're self-employed, you have to pay both the employer and the employee portion of CPP. CPP is going up, up, up. It used to be 4.95% for the employee and the employer. Now it's 5.45%. It went to 5.25% in between. It's continuing to increase the ceiling amount. So the amount that we're contributing into is actually going to increase by over 30% over the next couple of years. So the federal government has increased the mandatory CPP contribution. So that to me is a big downside to salary. Not that CPP is a bad thing, I guess, to collect, but think about it from the perspective of a self-employed person like you are. If I'm an employee, or take one of my employees that I pay as their employer, the employer portion of CPP. They pay the employee portion of CPP. So they're paying half what a self-employed person. A self-employed person has to pay both the employer and the employee portion of CPP. So they're paying double into the program what a regular employee pays into the program. And guess how much extra they get for doing that? Zero. Right? So if you're a self-employed person, you pay double into the program what everybody else in Canada pays, and yet you get the exact same benefit. So guess what your return on investment is? If the employee's return, Canada Pension Plan has set the return on investment for the average employee to be an inflationary rate of about 1.5%. So if somebody paying in half what you pay in is getting 1.5%, and you're paying double, you're getting a negative rate of return on your CPP. That's always been my position, and that's why I've recommended people pay dividends to themselves instead of salaries. With that said, I think that the tides have turned a little bit, and with the incentives the government's putting into salaries, I'm kind of flip a coin. If you're better at managing your money than some, then you may want to go dividends, because you're going to have to save money to be able to pay your taxes at the end of the year. If you're not great at managing your money and you'd rather just have that money submitted to the CRA every month so that you don't have to think about it at tax time, then salary might be the right decision. I hope that works, but it is a personal decision. There's no real one answer that's perfect for everybody. Casey, mic wasn't working. Is it working now? I hope everybody heard that. Yeah. Okay. All right. All right. So yeah, and Martin's put his contact information in there. I'd be happy if anybody reached out. If you have questions about how that insurance works or other uses of the insurance, which I haven't got into, which is more of an investment use, then that's something to definitely connect with Martin and his team about. Yeah. So let's continue on with a little bit of just the conceptual work, and keep those questions coming. That is by far the most effective way for us to get through this. Am I in presentation mode? I've got 3 screens here, and yeah, I'm in presentation mode. Okay. So thank you. Tax deferral versus tax savings. This is important to understand. What we're talking about with this 40% deferral, where you have 53% personally versus 12% in the corporation, it actually is a deferral. It's not a pure savings, right? Because someday you're going to have to take the money out of your corporation. And when you take the money out of your corporation, you're going to pay tax at a dividend tax rate, potentially. So a deferral means that I'd rather pay $1 to the government later as opposed to paying them today. Because in the meantime, I can take that $1, I can invest it, and I can turn it into 2 or 3. Right? So I hope that makes sense. Tax savings is the idea of paying less tax, right? As a result of something, a deduction, a tax credit, something like that. So our job as tax planners is to make sure that all of our clients get the advantage of every potential tax savings that's out there, but also to advise them on how to defer their tax. So the next best thing to a tax savings is a tax deferral. Again, if I can take that 40% savings or deferral, the difference between the 53 and the 12, and I can take that 40% and I can invest it for 20 years, that is seriously valuable. And then potential tax savings. Remember, I mentioned that we've got the ability since the 2018 legislation to split our income in retirement. So that could result in an actual tax savings, right? You defer it, and then you split it, and the split allows for a savings. Okay, so tax deferral versus savings, an important concept. The option that we talked about with multiple corporations, this structure right here. So you will hear, I'm going to give you just a little bit of an education on some of the structures. You'll hear people talk about holdcos. You'll hear people talk about family trusts. And for most real estate agents, you're going to start off with a PREC, and that's going to be it. It's going to be a simple setup with a PREC. If as you build money inside of that PREC, it may make sense to then start a holdco, which you might invest in real estate in that holdco. You keep things simple until it doesn't make economic sense to keep it simple anymore, right? That's my philosophy. So we start off with the simplest structure as possible. If I got a new realtor coming to me saying, hey, what do? I say, operate as a sole proprietor for the first year or so until you know what you're going to do. A lot of realtors, you guys know the statistics. I think 90% of the commissions earned are something like 10 or 15% of the agents that are out there. So that means there's a lot of agents that try to be realtors that don't end up making it. And so, you don't incorporate until you see that you're actually doing something with it. And until you have more money earned than you need to live on, then you incorporate. Once you incorporate, you take some time, a year or 2 or 3, until you save up enough money in that PREC where you've got money that you're going to invest into something that requires another corp. We set up a single purpose real estate investment corp at that point. The family trust, and I've just written so you can kind of get a feel for this while I'm talking, you can read a little bit. The family trust, so I'll give you an example. 10 years ago, we had tons of family trusts in our practice that were set up for the single express purpose of splitting income with adult kids 18 years and older that were in university, college, or not earning a significant income, because the tax rules at the time allowed us to do that. In 2018, I mentioned that there were some changes to the tax rules that were kind of adverse, negative for the small business owner. One of those changes was that they took away the ability to split income with children over the age of 18, unless you could prove that they were 100% actively engaged in the business. And it's actually pretty hard to do that. So the old thing, we'd have a 19-year-old in first year or second year university. We could flip a $45,000 dividend to them with almost zero income tax, $1,000, $500 of income tax payable. And so the best scenario I had, the best case I had was actually my wife's uncle, and he was a dentist. He's got 7 children. And at any given time for a period of years, he had at least 3 or 4 kids that were in university, not earning a single dollar. And we could split $45,000 a year to each one of those kids. So in a good year, we had $180,000 being split to his kids, another 45 to him, another 45 to his wife. And all of a sudden, we've got $270,000 coming out of his corporation, where he only paid, 15% tax. Back then it wasn't 12, it was maybe 15. And he was paying about $5,000 of overall personal tax on that. It was gorgeous. It was a beautiful plan. Kids back in the day used to be really good tax planning devices. And so in 2018, the federal government got wise to it. I get it. It was abusive. It really was. That scenario especially. You take somebody that's working downtown Toronto in a successful employment position earning $270,000 on a T4. Guess how much tax they're paying? It's probably in the ballpark of $120,000, $135,000, somewhere between there. And yet we had a dentist who was paying like $5,000 of tax on that exact scenario. So while I was quite proud of it, from a tax planning standpoint, it was not right. And the government's changed that. So family trusts are not used nearly as much today as they were 10 years ago, as they were 5 years ago. But they still have their purposes. So one of the things they did not remove was the ability to allocate capital gains exemption or capital gains through a family trust. So again, realtors don't sell their practices. So it's not really too applicable to you guys, but I know there's all sorts of tax cooler talk, water cooler talk. People come over and say, hey, you know what my accountant told me? Well, at least now you can understand a little bit. If they say they got a family trust and they own a manufacturing business, they have a family trust because someday that manufacturing business may sell for $5 million. And if they put a family trust in place and they have 3 kids, everybody in Canada is endowed with a lifetime capital gains exemption of $900,000. So if I've got a husband and a wife and 3 kids, I've got $4.5 million that I can use tax-free. It's a capital gains exemption on a qualified small business corp. So in that scenario, if I got a manufacturing business worth 5 million, I set up my family trust and have my 5 family members set up as beneficiaries to the family trust, and I ultimately sell the manufacturing business to a third party, I get most of that capital gains tax-free, right? So that would be why family trusts are in place. For you guys, you're going to kind of put an X through this family trust over here, and this is going to be your potential future structure for most realtors. You're going to have a PREC, and you're going to have maybe a hold co off to the side that owns a couple properties, or maybe it's 2 or 3 corporations off to the side, each owning 5, and you've got a beautiful little empire there with 15 or $20 million worth of real estate that you build up. But it's up to you as far as the structure is concerned. Okay.
Hey Rob,
yeah.
it's Laura Inward. Sorry, I'm not Zoom camera ready, so I'm just
no problem.
I'm pretending this is a phone call. Question, and the one that it still stumps me and challenges me a little bit with regards to the purpose behind the corporation.
Yep.
If it seems like it's becoming more and more challenging to get the funds out of the corporation into our personal hands, that the abilities to be able to use like the extraction of those funds in a way that you're not paying the full hit on tax. I get the tax deferral and the money's growing inside the corporation. I get all of that. Where I'm challenged is ultimately it's great to have a corporation that's earning money and that's developing wealth, and if we set up the right insurance structure, it's going to benefit our children and etc. But if we want to use that money during our lifetime and we want to get that money out of the corporation, it seems like the avenues to get it out of the corporation without being impacted at a significant tax rate is limited or becoming more limited.
No, you're bang on, Laura. You're right. And the government's put a lot of effort and time into trying to take away options and avenues that used to be there to be able to do that. My uncle dentist is the perfect example. That used to be a beautiful strategy, no longer available. So
I guess my question is, so while we have these corporations and we're set buying investment properties and they're earning money inside of there, if ultimately when we take all that money out, if we're using it during our lifetime, is there really a benefit to having money occur in the PREC initially, or should we just like rip the Band-Aid off and pay the tax right at the get-go, and then whatever you have, you have? So just your thoughts on that.
Yeah, and really great question. And and some people, I actually know some people who are like, what, I'd rather pay the tax now. Those people are few and far between, and there is definitely a quantitative, calculable benefit to deferring that amount of tax for a significant period of time. Now, just so everybody knows, Laura and I have worked together for a number of years, and I know she's a top agent. The income, again, if you can live on significantly less than you earn, then that deferral benefit and the ability to compound it on an annual basis inside of a corporation is significant. In retirement, there is a way to get the money out a little bit more efficiently with the ability to split income with your spouse. There's also additional tax credits in retirement that are not available now before you retire. And so you can get it out a little more cheaply. But so here, let me give you one example. And this is back to the old RRSP theory. So it used to be back in the day, I'd explain there are 3 benefits to an RRSP. Benefit number 1 is the immediate deferral. You contribute into your RRSP and it pushes the tax you would have paid on that money from today to 30 years from now, 20 years from now, however close you are to pulling it back out. So there's the deferral benefit. So that's there, Laura, with the corporation, the deferral benefit. The second benefit is the idea that in an RSP, while it's growing, it actually grows tax deferred. So if you make 10% return on your investment, you actually reinvest the full 10% instead of, if you're taxed at 50%, you're reinvesting the after tax amount. So an RSP has those two benefits. The third benefit to the RSP, so that's not there in a corporation. Investment income in a corporation is taxed, so that one we don't get. The third benefit, though, of an RSP is that when we take it out, the idea is that we take it out at a lower tax rate in retirement than we contributed at. So if you're a top income earner, you contribute to your RSP, get a deduction at 53%. When you pull it out in retirement, let's say you're not a low income earner in retirement, but let's say you're slightly less than you were while you're in it. So maybe you pull it out at 43%. There's a tax savings. So that timing difference between when you contribute and when you take out puts you at different phases and stages in life. So I contribute at a high bracket, I pull it out at a low bracket, and I split it. And so the tax savings is what's there. Now, with a corporation, let's shift from an RSP to a corporation. That first and third benefit are both there with a corporation. So we get the deferral. Instead of paying 50% now, we only pay 12% now. And so we get the benefit of the deferral. The second one's not there, like I said, but the third one is. So in retirement, you can plan your income and you can plan to take it out in a more effective way than you did at the time. See, when you're earning as a sole proprietor, you're a high income earner, you literally have no planning options. If you make net $500,000 of taxable income in your practice, you are paying tax on $500,000 at the highest marginal tax rate. And in retirement, I can choose to only take out 100 here, 100 there. I can plan it and I can time it. I've always been a big proponent. If you can control the flow of your income, you will pay less tax than if you don't control it. If you don't control it, it's out of your hands and you're probably going to pay the worst case scenario. So Laura, I hope that helps. Does that help a little bit? If you can.
Yeah, thanks, Rob. I appreciate the perspective.
So there is benefit to it, but that's why I put that slide up that showed the difference between a tax deferral and a tax savings. We are talking about a deferral. Hopefully we can also work into it a savings. The reality though is, like, if you're doing a reno, I know Laura just did a nice reno on her home, and if you do a reno on your home and you need money out of your prec, you got to pay tax on that money when you take it out. Now, there's some little tweaks that we can do. Laura, maybe can share with you what we did. We can set it up, and I've done it with a lot of clients, set it up as a long-term loan, almost like you're giving yourself a mortgage out of your corporation, so you don't pay all the tax up front. There's some, but that's like, it's not even really gray. It's kind of like on the dark side of gray. So the CRA wouldn't love that. But it's very hard for them to catch that kind of thing if you've got a corporation that has some investments in it. So in reality, there's planning opportunities. I saw Laura, you just unmuted. Do you have anything?
No, I just was going to make a joke about you telling people about our dark secrets.
It was another Laura, different Laura.
It's on the gray side of it.
I did it myself. Okay. But this is something, there's things that you can do, to take advantage of the timing of cash flow. And that's a huge planning thing. All right. We've got a couple of questions. So Ovi, open a prec with you in August. Awesome. Will the T2125 fixed asset, computer staging, furniture, car, etc., stay in the sole proprietorship, or better to move them so I can use them to depreciate? Yeah, we would definitely prefer to move them. So if we just set it up in August, then this year, and we'll be talking to you, Ovi, about that transfer of assets, that election that needs to be done. It's something that we think is worth everybody's time and money doing it, to transfer on a tax deferred basis all of the assets of the real estate practice, including, staging. I know is a huge thing. A lot of you guys run staging for your clients, and you build up a pretty significant stable of staging assets. So that's something that should go into the prec. Tanya, Ovi, do you have a comment? Sorry, go ahead.
Thank you.
Okay, Tanya, you've got, for people with large real estate portfolio, how can a family trust help with capital gains exemption of $900,000? Is that only for active businesses or can be used for real estate? Yeah, great question and good insight in asking the follow-up question. It is only for active businesses. So the capital lifetime capital gains exemption is for two things, well, three things: fisheries, farms, and active small business corporations. So there's three things, none of which apply to any type of passive corporation. So if you've got a corporation with any type of passive assets in it, there's actually an active asset test, which means that 90% or more of the assets in a corporation have to be employed in an active business in order to qualify for the capital gains exemption. Jen, wondering about when purchasing a new vehicle, can it be bought in the PREC? The answer is yes, it can be bought in a PREC. So once you have your PREC set up, if you're setting up a new car and it is your business vehicle, then yeah, you can put it in the PREC. I always caution people with vehicles. It's one of the areas of abuse, kind of like travel, meals and entertainment. You have to be a little careful with certain areas. Vehicles, the CRA put out a bulletin 3 years ago that it was going to be one of their #1 areas of focus. They've done a ton of vehicle audits over the last few years. And if you've got two vehicles, one can be in the corporation, but not the other one. So make sure that you don't have every vehicle that is in your name in the corporation, because one of them has to be personal use. So again, if you got two household vehicles, you can have one in the corporation, one personal. If you're, and the one in the corporation is only if you're active in your business. If I own an investing business, I can't have a corporation owned vehicle. There's just no call for business use in a corporation that just has investments. All right, Tanya's got, Rob, the condition for loaning money from the corporation for investments renos is 1 year and 1% needs to be paid, or you can forego the 1% if it's returned within 1 year and the clock resets? ? Yeah, well done. Section 15 sub 2 of the Income Tax Act deals with shareholder loans and benefits, and that's what it stipulates. It can be a short-term loan. Generally what we suggest, though, is you can kind of get away with extending that 1 year. Again, assuming that the CRA doesn't audit it. Generally, what I do for those types of loans is I actually set them up on the books of the corporation as an investment. It's a loan receivable, an investment, and we amortize it over 10, 15, 25 years, kind of in line with a mortgage that you'd get from a commercial institution. And the CRA actually sets the interest rate at 1%. Those are called the prescribed rates. There's a rate that's required between related parties, and that's the 1% rate right now. And yeah, so if you follow the rules exactly, which is why I said what I've done before with some clients is, we set it up and probably amortize it over a longer period of time than the CRA would like us to, but it's really kind of hard to see that in the financial statements of a corporation. So we do that fairly regularly. Yeah, any other questions? Well, I think I'm through just about everything that I wanted to with respect to the presentation. I'll put up, I know from a time perspective, it's already after 2. I want to be careful of that. So I'll just put up kind of our thank you. Like Tom introduced, we've been in operations now for quite a long time. I started the practice back in 2005. That's when I started working with Tom and Diane, and we deal with a ton of real estate agents. It's one of our sweet spots. We know it well. We've been dealing with setting up structures for real estate agents for a long time. 2020 was a real blessing because PRECs kind of solved all of the problems that we used to have. But we've got a number of companies within our group. We've got a great new group website, CBGRP, so the cmbgroup.ca. We've got wealth management, IT, HR, bookkeeping, law, and accounting, all under one umbrella, all under one roof. And we're happy to help you with your accounting and tax needs. If you have any questions, you're more than welcome to reach out to me. Carlos, maybe you and your team could flip out my contact information following this. Okay, any follow-up questions, guys, before we sign off? You were awesome with the use of the chat. It was a great way to do it. So all right, thank you, everybody. Thanks for the attention and participation. Carlos, I'll pass it back to you.
All right. Thank you so much, Rob. Well, Tom, do you have anything else to add or questions on your end? I think you're on mute.
Carlos,
I can
it's
see-
Carol
I
Fodder.
see
Can
you
I give
talking,
you a,
Tom. Oh, please. Yeah, go
Carlos,
ahead,
sorry.
Carol.
I just want to give a testimonial because about a year and a half ago, I transferred all my accounting over to Rob, and he has been phenomenal. I didn't realize I was in as disorganized shape as I was, but now he does all of my, he set up my prec. He probably saved me, not a word of a lie, probably $350,000 in taxes this year. It was a stuff, multiple corporations, and he always does it with a smile. They have amazing staff. They're available literally all the time. Sorry, Rob doesn't pay me to say this. I just have to sing his praises because honestly, it was life-changing for me to get affiliated with him as an accountant. So thank you, Rob, for everything you and your
Thank you, Carol. I really appreciate that. That's sweet. Yeah, we do our best. The good thing is I've been able to build a team, and we've got some amazing people around me. So as you could imagine, like I work with a lot of people. I'm actually trying not to take on new clients personally, but our firm, I've got 2 amazing partners. We've got 5 managers, tax and accounting managers in our firm, and a lot of great people. And we've built, the focus is on, hopefully on customer service, good customer service. But the most important thing is understanding how to help you guys structure and build your practices and your wealth. And Martin's got his comment there. My partners, Pierre and Duncan. Yeah, and better look. I mean, some say better looking, some do, I'm sure. So that's fine.
Can you hear me now, Carlos?
Go ahead, Tom.
Yeah, I just want to finish off with the fact that, Diane and I, when we first met Rob several years ago, prior to that, it was almost like we were dealing with an accountant who we had to push forward over coming up with ideas on how to defer, be creative, and do things. And not only did we feel like we felt good about Rob, that we trusted him, but he started to bring that kind of life into the things that we kind of expected, hope for, into an accountant. And that is just not doing our record keeping, but come up with ideas to be proactive, creative on how to do things. And we never wanted to do things that weren't by the book, but we also wanted to be able to take advantage of any legitimate taxable benefits could be taken, because we had a lot of moving parts, a lot of business activities, real estate ownership, all kinds of things. And it's the first time we got a breath of fresh air that Rob was the guy that was able to do it. And along the way, we built up a really strong, good personal relationship with each other. And you're in good hands. And you're in good hands with not only him, but his firm. So all his people that he has, you make sure that they're reputable and trustworthy.
Yeah, and good people. We got a good culture here. So, that's one of the things that I constantly get feedback on my staff, which is really nice to hear, just how good they are, how professional they are. So yeah, we're happy with the group we have. So if we can help you, look at your situation, we'll be happy to do that. And Tom, I appreciate very much. I've said it to you a million times that, the relationship we've had is fantastic. It's been, I think, mutually beneficial as you've helped me build my practice, and at the same time, I've been able to help you keep track and organize and plan properly for your situation. Cool. Thanks, everybody.
All right. Well, that wraps it up. For the recording of the session, you can visit our official YouTube channel. Just type Keller Williams Insider, and you will see the recording there in a couple of hours. So again, thank you so much. And this is another KW Sessions. Until then, we'll see you next time. You have a great, amazing day.
Rob,
Yes.
Rob, can you hang back for a couple questions, sir?
Sure, I'll hang on for a while. Sure, no problem.
More questions for those who want to stay. But we'll end here, and we'll say goodbye to the recording. Goodbye.
See you, everybody. Thanks, Carlos.